One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's Nightmare Winter. You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, the US, plus 3 large properties in Europe. Bonner says, we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. Bonner has made 3 similar predictions in his 50-plus year career, and each one proved to be exactly right, although he was mocked each and every time. That is why I strongly encourage you to read about Bonner's fourth and final prediction, totally free today. It's all spelled out in a free report we've put together about America's Nightmare Winter scenario. Get the facts for yourself. Go to AmericanWarning2022.com to get your free copy of this report. Even if he's only partially right, it will dramatically affect you and your money. So again, www.AmericanWarning2022.com.
Welcome to Making Money. This is Matt McCall. Thanks for joining me again live here at the annual Stansberry Research Alliance Conference. Sitting down with me, somebody I met for the first time this week. However, I've been reading his material for a very long time. Jared Dillian. He's the editor of the Daily Dirtnap. Thanks for joining us. I mean, I got to tell you, you are an old colleague of mine a few years ago turned me on to your writings. And I was like, holy shit, this guy, like, I can actually read it, understand it. You're funny. You share things that are pertinent to people, not just the BS from Wall Street. So thank you very much for what you do, number one. Number two, you know, obviously you come at things from all different angles. Mm-hmm. How do you kind of view where we're sitting right now, the economy, the market, the world, whatever you want to jump into?
Yeah, well, you know, the thing I talked about at the conference this morning was sentiment investing. Mm-hmm. And that's my comparative advantage. That's what I do. So, I mean, if you rewind a couple of weeks, even just quantitatively, like if you look at some of the sentiment surveys, sentiment today is more bearish than it was in the financial crisis. And I can tell you just anecdotally, like being online and Twitter, like people are predicting the end of the world. Like I've never seen sentiment so bearish, which is bullish. Mm-hmm. You know, it's absolutely bullish. Thursday, October 13th, we had the CPI number. It was expected to come in at 8.1. It came in at 8.2. The futures were down 100 pre-open. The market opened at 3,500 and immediately had a big reversal, like a 5% reversal intraday. And that has been the low. And there's a lot of shorts trapped at that level. So today, you know, we're talking today's the 26th, I think. Yeah. The Bank of Canada had a 50 basis point rate hike instead of a 75 basis point rate hike. Which is, now if you remember, the Bank of Canada hiked rates before the Fed and hiked rates faster than the Fed. They even had a 100 basis point rate hike. And they're going to be leading the Fed on the way down. The fact that they hike 50 and 75, you know, the central banks communicate with each other. They all respond to the same factors. And the fact that the BOC is getting more dovish at this point, we have the Fed meeting next week on November 2nd. There's really only like a 5 or 10% chance priced in that the Fed's going to go 50 instead of 75. But if they do, I can tell you the market is absolutely going to rip. And actually what I think is the most likely scenario is they'll probably go 75, but their forward guidance is going to indicate that they're almost done with rate hikes. So
I agree 100% with you. Whenever we get that, whether it's a surprise or whether it's the guidance going forward that surprises Wall Street, that's the time when it's kind of like, whew, you take kind of that black cloud and it's still hanging there, but some sunshine coming through there. And, you know, I looked at the numbers that if CPI month over month, going forward, the month over month numbers were flat, just zero, continuing starting October and going forward, we would be down in April to about 2.3%.
Yeah.
Even if it goes up 0.3% a month, which is above the average of the last 3 months, we'd still, by I think it's June, be down to 2%. So we're on a path that it's going to get there. It's just, I feel like what the Fed, and not that I'm saying the Fed did a good job by it means, Jared, but it's going to work its way in. We're starting to see commodity prices roll over, rent starting to roll over, housing prices starting to roll over. And do you think that investors will start moving in sooner rather than later in anticipation of what we're discussing here?
No, I don't.
Okay.
I actually think, the Fed doesn't really look at CPI, because CPI doesn't tell you what is happening today. It tells you what is happening 4 months ago. So, and as you mentioned, even if we have small increases in CPI, it's going to go down a lot in the next 4 months. But having said that, I think people sort of underestimate the short positioning in the markets. And right now, the market is about 8% off the lows. And, I see the shorts on Twitter and they're sort of in disbelief mode. Like they're like, well, it's just it's a bullshit bounce. We have to short it. It's going to make new lows. I see a lot of talk about earnings. Earnings have been bad. But stocks are up because expectations for earnings were so low that it was impossible not to beat them. So that's where we are today.
So Jared, you talked about sentiment today in your presentation out of Washington. It's a fantastic presentation. I also talked about the AAII, American Association of Individual Investors, how negative people are looking out 6 months from here. And I'm a contrarian investor as well. And we could show anything from the amount of puts being bought to the amount of cash in the sidelines, institutions, to CEO surveys, everything's so damn negative. I know that doesn't predict a bottom, saying right here's the bottom. That being said, historically, does that tell us that we're at maybe a sweet spot near a bottom?
Oh, absolutely. There's actually another sentiment indicator that I saw, a new one, assets under management for leveraged ETFs. So leverage long ETFs versus leverage short ETFs. And assets for leverage short ETFs are at the highest ratio to long ETFs in history.
Wow.
So that's another one. So, it does, look, like what I do with sentiment trading is, the sentiment sort of gets me in the neighborhood of a bottom or a top. And then I will use technical analysis to get more scientific about an entry point. And two things that I do, I use DeMark indicators and I use MACD, moving average convergence divergence. And when those line up along with the sentiment, that gives you a pretty clear buy signal. And you can actually get within a day or two of the top or bottom.
Did you have a buy signal in the last couple of weeks when we had the reversal after CPI?
Yeah, absolutely.
Okay.
Yeah.
And then, we obviously don't know. We don't crystal ball if that's a long term, if it's sustainable. We have one more leg down. Do you have any indication of the charts that this could be a sustainable rally?
I think it's sustainable, and I think it's going to sustain for about 4 to 6 weeks.
Okay.
And at that point, there will be a decision point as to whether we're going to consolidate and go higher, or there's going to be distribution and we head back lower. And that kind of depends also on the fundamental picture at the time. But, we had back in June, we had a 17% rally off the lows in June. But that rally, it was low volume. It was kind of a fugazi rally. And it actually went further than I thought it would. Like I thought it would go about 12%, but it went 17%. But even still, like if, sentiment, I'm a counter trend trader, right? And they tell you that you shouldn't do that. They say you should be a trend trader, right? Like Paul Tudor Jones, classic trend trader. Soros was a trend trader. But you can make a good living being a counter trend trader. If you can catch one of these moves, like 17% back in June, 17% is like a year.
Yeah.
That's
a good year.
You only need to do that once.
Yeah. So what are you doing with your own money right now?
Well, I'm not doing a lot of anything. I'm actually, it's kind of interesting because, my newsletter, the Daily Dirtnap, I have, like most newsletters, I have a model portfolio. And about 6 months ago, I said to my subscribers, what I do in the Daily Dirtnap is I trade alongside the portfolio. And that's one thing that my subscribers know is that I have skin in the game. Like I'm not just making recommendations, but I also had the same trades on. Yep. Now, obviously, I let subscribers trade first, and then I put the trades on afterwards and so on, for compliance reasons. But, I was personally invested in that portfolio. And 6 months ago, I said, look, like I'm building a house. I'm going to need capital. I need to sell some of these positions. I'm not going to be trading for about a year and a half. So we're basically going to have a legacy portfolio of stuff that's good for a couple of years. We don't need to touch it. And now we're going to have a paper trading portfolio, which is kind of cliche, but we're going to have a paper portfolio of stuff that I think is good. and we're just going to have that off to the side.
Okay.
So that's what I've been doing in the newsletter.
Is there certain sectors or trends that you go after?
Really kind of no. I mean, one of the things I've been focused on recently is Europe and emerging markets, right? So if you think about what's happened with valuations in the US relative to Europe over the last 15 years, like valuations in the US have gone straight up, and in Europe, they've gone straight down. And in Europe, you have this, I sort of coined a term for this, but I call it when you have stocks in the 6-6 zone. Okay. And the 6-6 zone is when you have stocks with 6 PEs and 6% dividend yields.
Oh, wow.
And Europe is full of cheap stocks that have 6 PEs and 6% dividend yields. Now, Europe is kind of a disaster right now with the energy situation and stuff like that. But if you're a contrarian, you say, look, like if I want to invest for 10 years, I mean, really in Europe today is like 1982 in the US, right? Where you have, I mean, remember that magazine cover, The Death of Equities, right? And like nobody would invest in stocks anymore. That's what it's like in Europe right now. So that looks attractive. Same thing with emerging markets. You know, if you go back 2002, 2003, emerging markets were like all the rage. You had the BRICS, you had Brazil, Russia, India, China. Like you had this decade of growth in emerging markets. And this year, the dollar has gone up 25%. Emerging markets have been killed. But if you start to dig into some of these emerging markets, ex-China and ex-Russia, but like Brazil in particular, like you have stocks with double-digit dividend yields, like incredibly cheap stocks. So there's a couple of ETFs that I picked for the newsletter. I said, look, if you just buy this stuff and you just clip like 6% coupons and the dollar starts to sell off once the Fed starts to cut or at least pivots, like that's going to be a great trade over the next 5 years.
I love that trade. And you know what I love even more about it is it's not a widely talked about trade right now. There's not a lot of people out there talking about that. I had somebody ask me in a breakout session yesterday about Volkswagen, and I recommended a while ago, we're down right now, but I think the P ratio is around 5 on it. I mean, it's amazing. And Volkswagen is one of the greatest car companies in the world, leading the EV revolution. And just Europe's a mess, like I said. Nobody wants to own Volkswagen stock. Could it go a little bit lower? Yes. But if I'm looking out 5 years, there's a good chance Volkswagen's will be worth a lot more in 5 years than it's today.
You know, ING has a 12% dividend yield. It's not distressed. This isn't like a dividend that's going to get cut. You know, it is a legitimate 12% dividend that you will get. There's a lot of stocks in Europe like that.
And you're going to look back on this in a year, 2, 3 years from now and be like, wow, what was I thinking? However, because we're human beings and we trade and invest with emotions, we look and say, at 12%, it must be something wrong with it, right? We feel like there's something wrong when if you do your research, you can see that it's really not. So I read the Daily Dirtnap, and as I mentioned when we started, I think you're one of the greatest writers I've ever read in the financial industry. Why don't you explain to the viewers exactly kind of how you started that and what your goal was with it?
Okay, well, you know, I used to be a trader at Lehman Brothers. I used to run the ETF desk. And when I started running the ETF desk in 2004, my boss at the time, who was the head of derivatives, he said, your job is not really to be a trader. Your job is to market the business, right? So I wasn't a marketing major. I'm like, what the hell? Like, do I put up billboards? Do I take out like ads? Like, what is he talking about? So I got an idea. So I said, well, you know, I'm good at writing. So I'm going to start sending out this market commentary and I'm going to build a following. And that's what I did. So for 4 years, like I sent out these Bloomberg messages and they went viral. And at the end of my time at Lehman Brothers, I had several thousand people on my distribution list. So, you know, I was offered a job to stay at Barclays, and I said, no, I'm going to start a newsletter. So I said to my subscribers on that list, I said, I'm going to start a newsletter, so join me, you know, at the Daily Dirtnap. And, you know, I want to say 10 or 20% of them did.
Yeah. And
that formed the basis of it. And that was in 2008. That was 14 years ago. So now I have about 4,000 subscribers. And it's been good.
That's great. So where'd the name come from?
So the name comes from, you know, I used to be a local on the P Coast.
Okay.
So the Pacific Options Exchange back in like 99, 2000, you had a lot of traders that used to surf because, you know, you get off work at 1 and they would go surf. So there were a lot of like surfer dudes on the floor that had long hair and stuff. and they had their own lexicon on the floor. You know, they would look up at the screen. They'd be like, dude, the spoos are taking a hella dirt nap. And
awesome.
like dirt nap was like a big word on the floor.
Yeah.
So I kind of stole it and I brought it back to New York, and now everybody says it. So
Because somebody asked me in the green room where it came from. I'm like, I don't know, but I'm going to find out where the hell it came from, because I couldn't even guess where it came from. I love it. So I ask every guest before I let them go, Jared, and you can answer, you don't have to answer. I always call it the island question. If I send you, your family, your friends, whoever you want to take to the most beautiful island in the world for 10 years, you could have one investment, one asset class, one ETF, whatever it might be. What's the one thing you own that you feel so confident that in 10 years from now, you'll be very, very wealthy?
I actually, you know, it's funny, since I'm building the house, I kind of set up my portfolio that everything I own falls into that category.
Okay.
It's stuff that I'm comfortable holding for many years. We talked about, I would say Europe and emerging markets, but since we already talked about that, in the US, I would say Airbnb.
Really?
I would say Airbnb, I think to hold for 10 years is probably my best investment.
Could you give me a short thesis on that? I'm fascinated. And I don't know much about the stock, but I'll say I've had a couple bad experiences with Airbnb internationally, and maybe it gave me a bad taste in my mouth towards the stock, you know, as that happens with people. What's your thesis?
Well, I've only had good experiences.
Okay.
I want to say I've had about 10 or 12 Airbnb rentals, and everything has always been great. Okay. Really, I think Airbnb has the potential to do what Tesla did to the auto industry. Now, if you remember when Tesla first started to rip, people were making these calculations. They were like, Tesla is worth more than Ford and GM and Volkswagen. It's worth more than the entire auto industry. That doesn't make sense. Airbnb is going to do the same thing to hotels. It's going to be worth more than Hilton, Marriott. It's going to be worth more than the hotel industry combined. When Airbnb went public, it was pretty expensive, and it's gotten a bit cheaper. But when people look at it, if they just look at like a straight PE, it's like 29 or 30 or something like that. It's still on the expensive side. Like this stock is growing very, very rapidly, and it is going to be bigger than the entire hotel industry over 10 years. So I don't really get too wound up in the volatility. I'm actually down money on it right now. I want to say my cost basis is around 135 or something like that. So I'm down a little bit, but I'm not touching that for 10 years.
I love that idea. I love when we have new guests come on with something outside the box. And you know, Airbnb, most people watching have heard of it. Almost everybody's heard of it, let's say. And the stock was hot when it went public, when, you know, little high valuation. It's not really that popular stock anymore, is it? I feel like the average people don't talk about Airbnb stock like they used to.
The valuation is going to get more and more attractive over time.
Okay.
Right. It's going to get a lot more attractive. So
do you see like as a play in millennials too, younger generation,
who
have
absolutely.
experiences, and traveling, doing things.
Yeah.
They don't need stuff. They'd rather go out and experience it. I'll tell you what, now I'm going to look into it. Thank you so much. I get a good idea. I get to meet a nice guy and get a great idea out of it. Thank you so much, Jared, for following me. And check him out, the Daily Dirtnap, Jared Dillian. We'll have a link down there below that you'll give us with people if they want to go check out more and sign up for your email. So thank you so much for joining us. We'll have you back next year when your book comes out.
Yep.
All right. Thanks a lot.
See you.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.